Hello my fellow freedom builders and welcome back to the channel. Now today's topic is about how to be the casino, and you might wonder, what does that mean? Well, we are going down a little math or statistics path today, but don't let that frighten you off. I'll make it very simple and easy to get, but what we are going to have a look at is how you can get an edge in the market. So basically what we are going to do is we're going to have a look at technical analysis and what that is really about, because many people, when they are looking at technical analysis or when they hear about it for the first time, they are seeing some graphs like this and it all may sound a bit magical and something about fortune telling and predicting where stocks are going to go, but in my opinion it has nothing to do with that. Technical analysis, looking at charts, is all about finding repeatable patterns, meaning finding something that you can see will make you a winner a bit more often than normal and maybe make your winners a bit larger than your losers. Because if you can find something that has this extra edge, then you have what is called in the casino and gambling world is called a positive expected value. Now let's have a look at it quickly. I suppose you all know a casino with a roulette table. You might wonder, why is that really such a good business case to own a casino? Well, the reason is that the casino owner has what is called a positive expected value. That means that from a statistical point of view, he earns money every time you place a $100 bill on the roulette table. Of course, he's not making money every time because sometimes you win, otherwise you wouldn't be there. But in the long run, he has a statistical edge. Let's try and have a look at it here. On a roulette table, there are 37 different numbers. There is from 1 to 36 and then there is a 0. Now that is on the European version. On the US, or at least some of the US versions of a roulette table, there are two. There are a 0 and a double 0, meaning that the casino's edge is just even larger. But let's have a quick look here. There are 37 spins in total of 37 numbers. And let's say you place your money on number 1 on the roulette table. We are spinning it 37 times, and in theory you will be winning one time, meaning the time where the little ball ends on number 1, and all the other times, if it is distributed completely equally, then you'll have 36 losers because it will end on somewhere between 2 and 36, and then of course the green 0. All right, your average winner, if you win, when the ball hits in the exact room with the 1 in, you win $3,500, meaning you're actually getting 36 times your money back, but you also placed a $100 bill, so you will be making $3,500 if you placed a $100 bill on number 1. All the others, you will be losing $100. That is how it works. So why is that such a good business for the casino, and how can we use it in our trading? Now, let's say that you spin the wheel 37 times and that it is a completely equal distribution. That means that you have one winning spin where you are making $3,500. That feels really good. But you have also 36 losing spins where you lose in total $3,600, meaning that your profit and loss, your P&L in total, will be the $3,500 minus the $3,600. That gives you minus $100. That is quite simple math. I think you get that. That means that you're actually not a positive expected value, but your expected value per spin is the minus $100 divided by 37 spins. That means that in theory, you are losing, every time you're placing a $100 bill on the table, you're losing $2.7 per spin. That is what the casino manager owner makes, and that is why he's interested in you keep playing. Because you know that if he has 1,000 people in his casino and they are all placing $1,000 all together one evening, that is $1 million placed. he will be making 2.7% of all that right into his pocket in theory. Of course, there will be nights where he loses money, or even a week where he ends up losing money because some people win big. But in the long term, over month, over years, he will be making $2.70 for every $100 bill that is placed on the roulette table. Now that is interesting, and you might think, okay, should I go out buy a casino? No, you should not. You should look at the stock market, because what we are looking at here is a bit different. We are still using technical analysis, and the reason why I am using that a lot, I'm also looking a bit at the fundamentals, but the reason why I really love using technical analysis is that it is so easy to backtest. If you have a pattern, and I will show you an example later, and I can tell on Sunday this week, that will be here in December. We're talking the 3rd of December. We are having a Danish webinar, and on Monday, the 4th of December, we are having an English webinar, and I'm putting the link in the description below here. In these webinars, we will show you how you can get a positive expected value, how you can get a long-term winning strategy using MyStockScanner, just using simple technical analysis. But let's have a look at an example here. And these are just made up numbers that can easily be different. Now, let's say we have 100 trades. We place 100 trades in different stocks over time. And let's say we have 60 winners and 40 losers, and that our average winner, every time we win, our average winner is $150. Our average loser every time we lose is $100. And these are actually close to the stats that I will show you on Sunday and Monday how to get, because we have chewed on a lot of data since back in 1986 on all the large stocks in United States. And these are actually very similar to the numbers we are coming up with. Now, what are we looking at here? Well, we can make the exact same calculation as we did before with the roulette table. We can say we have 60 winners where we are making $150. That's $9,000. We have 40 losers where we are losing $100. That is $4,000. Now our P&L in this case is 9,000 minus the 4,000. That is $5,000 that you make on 100 trades, meaning that your positive expected value per trade is 5,000 divided by the 100, that is $50 per trade. So what you can expect in the long run is that you can take the number of trades you have placed, you can multiply it by $50 in this case, and that will be a long-term gain. Does it mean that you can't be losing 5 trades in a row, or 10, or even 15 trades in a row? No, not at all. But let me show what, if we are looking at a little analysis of this, how this could pan out. Now in here, I've chosen a website called forexsignals.com. They have some free tools up here, and they have what is called a Monte Carlo simulator. Now, what is that used for? A Monte Carlo simulator, of course, it smells a bit like a casino, I think. But let's say, for instance, that you start out with $10,000. And you are risking, let's say, 1% of your capital for every single trade if your stop loss is hit. And let's use the percentages I mentioned before. 60% winners, there are 0 break even, and then of course that will leave us with 40% losers. Let's say that you place 10 trades per month, and we are having a look at this over 10 years, meaning 120 months. Now, take profit to stop loss ratio. As you saw before, the winners were $150 and the losers was $100. So that means that we will have a win to loss ratio at 1.5, meaning our winners are 1.5 times as big as our losers. And yeah, you can see they want to sell something and make a sign up here, but it is free to use. Now what we can do here is that when I press simulate returns, it starts to make a very high amount of different statistical simulations. Like it is flipping a coin hundreds and hundreds of times, just with us not having a 50-50 chance, but a 60-40 chance, where the winners will be 1.5 times our losers. Let's try and take simulate results. It is chewing on the numbers here, and you can see this is the span of results here over 10 years. Let's just look at the worst case scenario here. Now this is pure stats, and if I press this once again, it would be a bit different because it's just a random calculator. But what we can see here is that if we were placing 10 trades per month with the stats I showed you, the positive expected value, there would still be losing trades once in a while, here and here. Here you can see and here there are 3 losing months in a row. So you can easily lose money even though you have a positive expected value. But if we look at the results, we can see that we started out with $10,000. We end up with $625,000, and of course this is just a simulation. Our maximum drawdown would be 7.8%. We would experience 8 losses in a row at some point over these 10 years, and we would experience a maximum of 9 winning trades in a row. Now this is, even though we put in 60% win rate, you can see that in this worst case, it only had 53.6% winners. However, even though that was a bit lower, you can see we are making 31% per month, 18%, 93%, that was a good year, 25, 35, and so on. And as you can see, if I press this again, it just runs all the numbers once more, and we get some different results. Here we're getting a 15% max drawdown, 13 winners. What if we simulate again? You can see 11% drawdown. So it's not static, and these are not a guarantee for you to make money. But if you want to make money, you need a repeatable pattern that you can do statistics on. Now this is the absolute worst case. So that is the red line down here. We can also choose the most possible, and that is the midpoint here, the blue one. And you can see every single of these lines are, I think there are 100 lines every time we do this. So it is doing 10 years of calculation with 10 trades per month, and all of these stats, they're doing that 100 times to give us a reasonable statistics here. So the most possible is giving us a 7.3% drawdown. It'll take $10,000 to be almost $3 million. And of course there are no taxes and all that stuff in here. You can see that the win percent is close to 60%, and you can see we have some magnificent years here. Now you can easily have a losing year even though you have a positive expected value, but without a positive expected value you will in the long run lose money, just as if you went to the casino. So that is why when I am looking at strategies, I'm looking at something we can test. If I want to include some fundamentals, some price earnings, some price to book, some whatever ratio you want to look at, I'm making sure that I have the historical data so I can backtest it. And in here, in MyStockScanner, that is what we do, and you will see a ton of stats coming out from us in the upcoming weeks and months. And for instance, when we are looking at a stock, let's just take the Danish Novo Nordisk. That is a stock many people know because of their weight loss medics right now. What we are doing here is that we are trying to quantify everything. We have all the ratios out here. We have the TPI chart, and the webinar on Sunday and Monday will be about the TPI, because here we have taken, as I mentioned, these different results, the light red, the dark red, the dark green, and so on the different levels, and we have tested and tested and tested of almost 40 years of data, and in all sorts of variations. And what I will show you in Danish on Sunday, in English on Monday, is some of the results. We will keep making webinars because we have so much juicy data to give you, and I promise you it won't be boring, because you will be able to see how you can make money with this, just with something as simple as the TPI indicator. And no, this is not predicting the future. This is looking at the past and saying, okay, if something has worked over the last 40 years and has worked consistently with most years being in profit, most months being in profit, but of course once in a while losing money. If we have seen 40 years of something that works, then we are quite confident that it will work the next month and the next year as well. So that is what the webinars are about, and I hope this made sense, talking about being the casino, trying to get the odds on your side so that when you are trading for years or even many years, 5 or 10 years, and you have the stats on your side, then you are quote unquote guaranteed to make a profit. I will give you some more tools for it in the webinars, and I hope that you have been in testing the MyStockScanner. Otherwise, I'll put a link to that in the text below here, and there's a 14 days free trial there. And yes, I hope to see you on the webinar. Links below. Remember to subscribe and like and all that jazz, and I'll talk to you again shortly. Take care of yourself and your money out there.